Hello and welcome to Energy Insights, your trusted source for in-depth analysis of the global energy markets. Today we cover key developments shaping the energy supply, demand and prices. From Europe gas storage concerns to LNG market dynamics to structure shifts in the global energy landscape. Let's dive right in. Under the segment 1, we are covering the European Union gas storage and supply risk. So this segment focuses on Europe's energy security amid geopolitical tensions. The European Commission has urged EU member states to begin refilling their natural gas storage facilities earlier than usual, potentially as soon as April of this year. This move aims to prevent a costly scramble later in the year. Supply disruptions linked to the Middle Eastern war are adding pressure on the LNG and the pipeline imports. Gas prices have surged more than 70% since the conflict began, while the EU storage overall is only around 28% of the full capacity, with some countries far lower. Although core supplies like Norway and the United States remain reliable, but still the regulators want to avoid last-minute competition for cargoes that could push the prices higher. This development highlights how geopolitical risk is now a dominant factor in the European energy planning, forcing policymakers to focus on the storage, consumption, and supply diversification. Similarly, under the segment 2, we are covering the energy transition shift by one of the mega scale player of the sector from the offshore wind to LNG. So this segment highlights a major strategic pivot in the energy sector. French energy mega player Total Energy has exited the US offshore wind market, relinquishing key leases awarded in 2022. Instead, the company is redirecting nearly $1 billion investment towards the LNG and the upstream island gas investments opportunities, including the Rio Grande LNG project in Texas. This shift reflects the challenges in the offshore wind, rising costs, permitting delays, and the supply chain issues, while LNG demand surges in the Europe and the Asia offers as an alternate. So for Total Energy, it's been reported it's not a retreat from the energy transition, but a strategic reallocation towards the segments offering stronger returns and greater energy security, with LNG emerging as a critical bridge fuel. In the segment 3, we are covering the power demand surge and the grid constraints. So, examining the US electricity grid and rising the power demand, regulators are raising concerns that major tech companies are not engaging sufficiently with grid authorities despite rapidly growing electricity needs. The AI-driven data center boom is creating unprecedented power demand, with hyperscalers investing hundreds of billions into the digital infrastructure, yet securing reliable electricity supply has become a key bottleneck. While traditional utilities coordinate with the grid operators, many tech firms still lack understanding of the grid operations and connection timelines. This disconnection is causing project delays and adding pressure on the already strained networks. As AI adoption accelerates, competition for electricity between the industrial users, households, and data centers will intensify, potentially driving up prices globally. Energy security and digital expansion are now deeply interconnected. So in the segment 4, we are looking to the market data and the price volatility as a snapshot of the global energy markets as of today. So crude oil leads today's rally. WTI reported price $94 per barrel, which observes an upscale moment of 4.7% from the last day price. Similarly, Brent crude price being reported $108 per barrel with the up movement of 5.7%. Natural gas and LNG prices are diverging across regions. And in the case of the JKM, it's been around $20 to $21 per MMBTU, TTF around 46 to 50 euro per megawatt hours, which is in equivalent terms of the MMBTU becomes $14 to $16 per MMBTU. The Henry Hub price reportedly been $3 per MMBTU, while in case of refined products, which were observed most volatile, in the chain. The heating oil price being increased by around 7%. Similarly, the gasoline by up to, was remained around 4% on the upside. Gasoline and diesel also observed on the upside of 11%. So European Union carbon prices were around 71 to 72 euro per ton, while major equity indices are down from 4 to 5%, highlighting a divergence where energy commodities outperform equities. The takeaway is that the supply tightness, refining constraints, and the geopolitical risks are driving volatility, especially in the refined fuels. In the segment 4, we are looking into structural trends and market outlook. So, at the broader market outlook perspective, global energy systems are under pressure from rising industrial demand, data centers, consumption, and continued reliance on the fossil fuels. Infrastructure constraints from LNG terminals to crude export capacity are shaping the market dynamics. Today, energy markets are influenced not just by the production but by how efficiently energy supply is transported, stored, and delivered. Carbon markets are also increasingly significant, with rising compliance costs affecting decisions for power producers and the industrial players. The short-term outlook points to continued volatility as markets respond to supply disruptions, geopolitical developments, and infrastructure limitations. In the medium to long term, the interplay between the energy security, energy transition policies, and infrastructure investment will define the global energy market landscape. And that's all for today's on energy insights. From the European gas security and LNG demand to AI-driven power challenges and the latest commodity volatility, these developments are shaping energy markets worldwide. If you found this analysis insightful, like, share, and subscribe, and hit the notification bell so you do not miss our next market briefing. Thanks for watching Energy Insight, and we'll see you in the very next episode.